Assalamualaikum and welcome to our video. In this video, we will make a presentation on audit of revenue or sales on received cycles. Our group consists of 4 members including me, which is Julisa Nur Amira, Adwana Baktisha, Ridina Safia, and myself, Nurin Sharafina.
Part A, Sales and Collection Cycle.
Let's begin with the introductions of sales and collection cycles. Sales and collection cycles is the process a company go through when it sells goods or services and collect payment from customer. It includes steps like receiving customer order, delivering the goods, sending invoice, and collecting money. This cycle is important in auditing because it affects sales, cash, and account receivable. It also has a high risk of fraud like fake sale or unrecorded returns. So, auditor must check that everything in these cycles is complete, correct, and recorded properly. Now, let's continue to classes of transaction and business functions. First is sales. The function of sales is processing customer order, granting credits, shipping goods, billing customer, and recording sales. Second, cash receipt. The functions of cash receipt is processing and recording cash receipt. Third, sales return and allowance. The functions of sales return and allowance is to processing and recording sales return and allowance. Fourth, return of uncollectible accounts is to write of uncollectible accounts receivables. Last but not least, bad debt expense. The functions of bad debt expense is providing for bad debts. So this is the flowchart of sales and collection cycles. Next is function and document related to sales. First, we have customer order. Customer order is a request made by the customer for goods and services initiated the sale process and usually includes product descriptions, quantity requested, and delivery instructions. Second is sales order. Sales order is internal document prepared based on the customer order. It used to communicate descriptions of goods, quantity orders, and pricing and other details. And it also used to authorize further steps like credit approval and shipping. Third, shipping document. Shipping document is prepared to initiate and confirm shipment of goods. It includes the descriptions of merchandise, quantity shipped, shipment date, and the courier details. It also serves as evidence of goods transfer. Fourth is sales invoice. Sales invoice will send to the customer after shipping. It indicates descriptions and quantity of goods sold, unit price, and total amount, freight and insurance charge if any, terms of sales like payment terms, and used for recording revenue in the accounting system. Next is sales transactions files. Sales transaction file is a computer-generated file maintained by the accounting system. It includes all processed sales transactions for a period like daily, weekly, or monthly. It used for prepare reports like sales journal, updating account receivable, and audit trail for testing accuracy and completeness. After that is sales journals. Sales journal is generated from the sales transactions files. Includes customer name, date of transactions, amount, account classification or classification for each transactions. Next is account receivable master files. It records individual sales, cash received, sales return and allowance, maintain customer account balance. Next is account receivable trial balance. It's a list or report showing amount receivable from each customer and a specific point in time. Last but not least is monthly statement. Monthly statement is to send to customer by mail or electronically. Includes beginning balance of account receivable, amount of sale, cash payment received, credit memo issue, and ending balance. After that, we proceed with the functions and document related to cash receipt. So first we have remittance advance is a document signed with sales invoice. It also written by customer with cash payment. Second is pre-listing of cash receipt. It was list prepared when cash is received. Also prepared by person without access to accounting records. Third is cash receipt transaction files. It was computer generated files and contains all cash receipt transactions for a period. Last but not least is cash receipt journal. It is a report generated from the transaction file. It also lists all cash receipt transactions for a time period. Next, we proceed with the functions and document related to sales return and allowance. First is sales return and allowance journal. A special journal used to record all transactions involving sales return or allowance. Second is credit memo. A document issued to the customer indicates a reduction in the amount owed issued due to the returned goods or granted allowance. Next, we continue with the function and document related to write-off of uncollectible accounts. First, we have uncollectible account authorizations form is an internal document, grants official approval to write off an account receivable, ensure proper authorization and internal control. Second is general journal, which is used to record non-routine transactions, includes write-off uncollectible accounts, capture the accounting entry for the write-off, such as debit bad debt expense and credit account receivable. Next, we continue with the functions and document related to bad debts, which is general journal. General journal is used to record the bad debt expense entry. Typically, entry is debit bad debt expense and credit allowance for doubtful accounts, or account receivable if writing off directly. Now, let's continue with the misstatement that could occur in the revenue process. So first, we have recording fictitious sales, recognizing revenue on the shipment that we are not made. Second, shipment of more goods than the customer order. Third, yearly shipment of goods, recognizing revenue before the customer requests delivery. Fourth, yearly sales recognitions refer to recognized income in the current year even if the product or services are shipped or provided in the next year. Last but not least is recognition of revenue based on swap or exchange transactions by which the customer and the client exchange product or services, recognize revenue based on the exchange.
Hello, my name is Adana Batusha and now I will explain to you through these two critical flowcharts, which is the typical credit sale flowchart and the typical cash collection flowchart. Additionally, I will explain the methodology for designing tests of control and substantive tests of transaction of for sales. This will give us comprehensive understanding of the processes and the importance of internal control in auditing. Let's begin with the credit sales flowchart. This flowchart outlines the journey of a sales transaction, starting from the initial customer order to the final invoicing stage. The process begins when a customer order is recorded as an internal sales order and forwarded to the credit department for approval. The customer's creditworthiness is reviewed using past records to avoid potential bad debts. Once credit is approved, the shipping department prepares the shipping order and the bill of lading. The shipping order is checked for any discrepancies against the original customer order to ensure accuracy. The bill of lading is then prepared for both the customer and the carrier, with the carrier's copy used to collect the customer's signature upon delivery as proof of receipt. Third is invoicing. The invoicing department reconciles the customer order, shipping order, and bill of lading to prepare the sales invoice. Once completed, the invoice is filed and sent to the customer. Fourth is recording in accounting. The accounting department records the invoice details in the sales journal and updates the accounts receivable master file. This ensures the sale is accurately reflected in the company's financial records and the customer's account is updated accordingly. Overall, this flowchart ensures each step of the sales process is properly documented and controlled, minimizing errors and supporting accurate financial reporting. Next, we have the typical cash collection flowchart, which outlines the steps from receiving checks to updating the customer account. First, receiving and listing checks. The process begins when checks are received from customers. These checks are listed in a pre-listing, which is cross-referenced with any available remittance advice to ensure accuracy. Second, bank deposit and reconciliation. A bank deposit slip is prepared and verified by the bank to confirm the deposit. The pre-listing is then reconciled with the remittance advice, and the entries are recorded in both the cash receipt journal and the account receivable master file. Third, updating customer accounts. Using the updated accounts receivable master file, customer statements are prepared to reflect the received payments. This ensures all cash receipts are properly documented and recorded, reducing the risk of errors or fraud. By following this flowchart, companies can maintain a strong cash collection process, ensuring that all received funds are accurately recorded and accounted for. Finally, let's discuss the methodology for designing tests of control and substantive tests of transaction. This methodology is essential for ensuring that audit objectives are met and that internal controls are effective. First, we must understand the internal control over sales, which involve reviewing relevant flowcharts and existing processes. Second, we assess and plan control risks to identify any potential weaknesses in the control environment. Third, we determine the extent of control testing, deciding how much testing is needed based on the assessed risk. Fourth, we design tests of control and substantive tests of transaction to ensure they address transaction-related audit objective. Key components of this step include audit procedure, defining the specific steps to test the control, sample size, determining how much transactions will be tested, items to select, identifying which transaction or documents to test, timing scheduling when the test will be conducted. By following this methodology, we support a thorough audit process that identifies and addresses issues in the sales process, ultimately strengthening the accuracy of financial reporting. In conclusion, understanding and applying these flowcharts and audit methodologies is crucial for effective internal control and accurate auditing. By carefully following this process, companies can ensure strong financial management and reliable financial reporting. Thank you for your attention.
Hi everyone, my name is Janissa Nur Amira. In this video, I will explain how auditors check sales transactions, and I will talk about the audit objectives, the controls that companies use, and how auditors test those controls and the sales transactions themselves. The first audit objective is called occurrence. This means we want to make sure that the sales are recorded by the company actually happen and are not fake. To achieve this, companies have certain controls. For example, credit is approved automatically by the system based on set credit limits. Also, all sales must be supported by documents such as shipping records and customer orders. Auditors test these controls by checking the customer orders to see if there is proper approval. They also look at sales invoices and match them with the shipping documents and customer orders. In the next step, auditors perform substantive tests. They check the sequence of sales invoice to make sure none are missing or duplicated. They also review the sales journal and master file to spot any unusual transactions or amounts. The second audit objective is completeness. This means the auditor wants to make sure that all sales that should be recorded are actually recorded. To do this, companies use controls such as pre-numbered shipping documents, which are checked weekly. They also compare the total quantity shipped with the quantity billed to customers. Auditors then test these controls by checking if the shipping documents are in order by looking at batch totals. They also make sure that these files are reviewed by the data entry staff by checking for their initials. Finally, auditors carry out substantive tests by tracing a few shipping documents back to the sales journal. This helps them confirm that every shipment was properly recorded. Now, let us continue with two more important audit objectives for sales transactions, which are accuracy and classification. The first objective here is accuracy. This means the company must make sure that sales are recorded at the correct amounts and match the goods that were actually shipped. To support this, companies use controls like matching sales with authorized shipping documents and approved customer orders. They also compare the total quantity shipped with the total quantity billed. To test these controls, auditors will look at the sales invoices and check if they have the right supporting documents. They also review batch files for initials from the data control clerk to make sure someone verified the totals. For the substantive test, auditors trace the sales journal entries back to the sales invoices. They also recalculate the prices and amounts on the invoices to check for any mistakes. The next audit objective is classification. This ensures that sales are recorded in the correct accounts. The key control here is that account classifications are initially checked before recording. To test this, auditors examine the full document package to see if the accounts were properly reviewed. Then, for the substantive test, auditors look at duplicate sales invoices and check whether the sales were recorded under the correct accounts. Now let's look at the last two audit objectives for sales transactions, which are timing and posting and summarization. The first objective here is timing. This means that sales should be recorded on the correct date, not earlier or later than when they really happen. The key control is that shipping documents are pre-numbered and checked weekly by the accountant. To test this, auditors look at the sequence of shipping documents to make sure none of them are missing or recorded late. For the substantive test, auditors compare the date of the sales in the sales journal with the date on the duplicate sales invoice and the bill of lading. This helps to ensure that sales were recorded at the right time. Next is posting and summarization. This means that sales must be properly recorded in the accounts receivable master file and accurately summarized in the general ledger. To control this, the system automatically posts the transaction to both the master file and the general ledger. Then, every month, the master file is reconciled with the general ledger. As a test of control, auditors check if there is evidence that the reconciliation was done between the master file and the general ledger. For the substantive tests, auditors trace selected sales invoices from the sales journal to the account receivable master file. They check the amount, date, and invoice number. They may also use audit software to total the journal and compare it with the general ledger to make sure everything is correct. As we move on to cash receipts, auditors also need to check whether the cash recorded by the company is real and properly handled. Let's look at two audit objectives, which are occurrence and completeness. The first objective is occurrence. This means we want to make sure the cash receipts recorded are for actual cash by the company received. One important control is that the accountant independently reconciles the bank account. Also, the batch totals of cash receipts are compared with computer-generated summary reports. To test this, auditors observe whether the accountant is really doing the bank reconciliation. They also check the batch files to see if they were reviewed and signed by the data control clerk. For the substantive test, auditors review the cash receipt journal and the master file to find any unusual transactions or amounts. Then, they trace the cash receipts for the journal to the bank statement to make sure the money was really received. The second objective is completeness. This means the company should record all the cash it actually received and nothing should be missed. To control this, companies prepare a listing of all incoming cash. Also, checks received are stamped with a for deposit only endorsement to avoid misuse. Auditors test this by observing the listing process and watching how the company handles incoming checks. For the substantive test, auditors get a copy of the pre-listing and compare it to the cash receipt journal. They test the names, amounts, and dates. They also compare the pre-listing with the duplicate deposit slip to confirm accuracy. This presentation, I will explain the audit process for cash receipts, focusing on transaction-related audit objectives, key controls, test of controls, and substantive tests. The first objective is accuracy. This means the company must record cash receipts at the correct amount, not more or less than what was actually received. To control this, the account independently reconciles the bank account and batch totals of cash receipts are compared with computer summary reports. Auditors test this by observing whether the accountant performs the bank reconciliation and by examining the batch total files for initials of the data control clerk. For substantive tests, auditors obtain the pre-listing of cash receipts and compare the amount to the cash receipt journal. They check the names, amounts, and dates. Auditors also prepare proof of cash receipt to ensure everything was recorded accurately. The second objective is classification. This ensures that cash receipts are posted to the correct account. For example, whether it's from a customer payment or another source. To control this, each cash receipt transaction is internally verified by the staff. Auditors test this by examining evidence of internal verification, such as initials or signatures showing the transaction was checked. For the substantive test, they examine the pre-listing of cash receipts to make sure everything is classified into the correct accounts. The next audit objective is posting and summarization. This means cash receipts should be correctly included in the accounts receivable master file and properly summarized in the general ledger. To ensure this, companies have two main controls. Monthly statements are sent to the customers. The computer system automatically posts transactions to the accounts receivable master file and general ledger. Auditors test these controls by observing whether the monthly customer statements are actually sent and examining evidence that the accounts receivable master file is being regularly reconciled to the general ledger. For the substantive test, auditors do two things: trace entries from the cash receipt journal to the accounts receivable master file and check for accuracy in dates and amounts. Then they do the reverse, trace credits from the accounts receivable master file back to the cash receipt journal, again testing for correct dates and amounts.
Hi, my name is Nur Idina Shafia and I will explain about the crucial topic of analytical procedure for the sale and collection cycles. This process is fundamental to ensuring the accuracy and liability of financial statement, particularly concerning sales and accounts receivable. As we can see from the table display, there are several key analytical procedures that auditor employ to identify possible misstatements. So let's explore this more detail. The first one, we got the comparing gross margin percentage with previous year by product line. This procedure helps us identify any significant deviation in gross margin which could indicate an overstatement or understatement of sales and account receivable. By examining this percentage, auditor can pinpoint area that require further investigation. Next one is comparing sales by months over time. This method allows us to detect irregularities in sales trend. Any unexpected function could suggest potential overstatement or understatement of sales and account receivable. The need for close look at the underlying transaction. Next one is comparing sales return and allowance as the percentage of gross sales with previous year. Sales return and allowance are critical indicator of the quality of sales and customer satisfaction. By comparing this figure year over year, auditor can identify possible overstatement or understatement that might affect both sales return and account receivable. Comparing individual customer balance over a state amount of previous year. Monitoring individual customer balance over the time helps in detecting anomalies that could indicate misstatement in account receivable and related income statement. Significant change in customer balance could reflect issue with billing collection and revenue recognition. Next, comparing number of days that account receivable are outstanding with previous year and related turnover of account receivable. This procedure helps identify any changes in financial period which might suggest issue with credit policy or collection efforts. Significant deviation could indicate overstatement or understatement of the allowance for uncollectible accounts and bad debt expenses. Additionally, it may highlight the principle of fictitious account receivable. The next one is comparing aging categories as a percentage of account receivable with previous year. By examining the aging categories, we can assess the quality of receivable. A shift in the agent profile might indicate potential issue and collectability, leading to overstatement or understatement of the allowance for uncollectible accounts and bad debt expenses. This analysis helps auditors determine if receivables are appropriately managed. Next is comparing allowance for uncollectible account as a percentage of account receivable with previous year. This shows that the allowance for uncollectible account is in line with historical trends. Vision from the non-call signal overstatement or understatement impacting the accuracy of the financial statement is essential to validate that the allowance reflects current economic condition and credit risk. The last one is comparing charge of uncollectible account as a charge of total account receivable with previous year. By monitoring the charge of rates, help is assessing the efficacy of allowance for uncollectible accounts. Anomalies in this percentage could indicate improper estimation of bad debts, leading to potential misstatement. This procedure can ensure that write-off or consistently apply the accuracy reported. By employing this analytical procedure, auditor can provide a comprehensive evaluation of the accountable and related allowance. This measure not only help in identifying potential misstatement, but also ensure that the financial statement present a true and fair view of the company's financial position.
Next, I will explain the procedures for testing accounts receivable to ensure the accuracy and validity in the financial statements. First, we review the accounts receivable trial balance and identify any large or unusual balances needing special attention. Then, we perform analytical procedures to detect significant changes from prior years and investigate discrepancies. We review the age trial balance to verify that notes and third-party receivables are properly classified and valued. It's important to inquire with management about related party notes or long-term receivable and review board meeting minutes to check if any receivables are pledged or factored. Next, we trace accounts from the trial balance to the master file to confirm the aging and balances. We cross-put and total the aging column across all pages to ensure accuracy. Then reconcile the balances to the general ledger. We perform a detailed test on 5 accounts by tracing them from the master file back to the aging trial balance. We confirm the accounts receivable balances by sending positive confirmation to customer. For any confirmations not written after follow-ups, we perform alternative procedures such as discussing collectibility with the credit manager, reviewing subsequent cash receipt, and examining credit files for large accounts. We then evaluate the allowance for doubtful accounts for accuracy. We select the last 20 sales transactions of the year and trace them to shipping documents to verify shipment dates and proper recording. Finally, we review large sales return and allowances before and after the balance sheet date to ensure correct period recording.
For the part B, we are required to discuss about the case relating to the sales and collection cycles from the past year questions. Here is the extract question from February 2022, question 5B. We can identify 5 possible internal control weaknesses from the company. First weaknesses is there is no appropriate requirement for the client financial statement capabilities as evidence in justifying the client credit worthless. The impact in the absence of additional financial supporting documents of the client would lead to the risk of choosing a bad paymaster client. Our suggestion is the company should strict in requirement financial capability of the clients to make sure they are capable to pay back debts. The second weaknesses is there is no proper segregation of duties by the clerk in reviewing and approving the applications. The impact of these weaknesses can lead to bias or inaccurate decision making in approving the application. We can suggest that companies should set a proper segregation of duties to make sure there will be no bias. The fourth weaknesses is infrequent generation of debtors. Aging report might cause inefficient credit collection performance due to the lack of monitoring frequency. Monthly report deems insufficient. The impact of this situation are the report that is generated on monthly basis pose a higher risk on the credit collection performance that the report is generated on daily or weekly basis. Our suggestion are the company should monitoring the frequency by record and notify the creditors by daily or weekly basis. Lastly, lack of strictness, proper and effective procedure in the credit collection mechanism in countering bad paymaster clients. This will cause the number of clients with the bad debt account will be high and becoming uncontrollable. We suggest that the company should improve their procedure in credit collection mechanism. Thank you for watching our video. Hope it can give more knowledge about audit of sales and receipt cycle.